Essentially, what you're saying is the bottom could be Nifty going to 20,000 level.
But IT is not a growth play because there is no visible growth path for IT. It is only a value play.
2026, I call it worst year.
When you mentioned that this is the worst year, 5 years later, you will say this was the best year. This AI is like the California gold rush. That everybody is out there digging sand in the California sands to find gold. But the sad part of it is that there will be only a few winners. If the market has corrected so much, why are we still talking about valuations being expensive? Because...
Hi friends, my name is Rahul Jain and I'm a SEBI registered research analyst. Today, I have invited Mr. Sunil Subramaniam, who's got ton of experience when it comes to stock market and also corporate world. He's been in the corporate world for more than 40 years. And in his last role, Sunilji was the managing director of Sundaram Mutual Fund, right? So a lot of experience. And today, what we want to do is we want to talk about a lot in terms of the current geopolitical situations that are driving our markets down. I know you all have a lot of questions around, where the market bottom is, whether the market will continue to fall more, are there buying opportunities, etc. So I'll try and cover as many questions as possible in this short conversation. So Sunilji, thank you so much for your time. I really appreciate it.
Thank you.
Sunilji, I want to start this conversation on the current conflict that is going on, right? And I was looking at some data, and if I just talk about the FIIs, up until 16th of March, in the month of March, only 16 days have gone, and they have sold around 66,000 crores. Okay, so the entire month is not even completed, and they have already sold 66,000 crores worth of equity in the cash market. And if I look back the last 12 months, of course, there have been net sellers. We all know that. But in the last 12 months, this has been the highest selling by FIIs, right? And mind you that, there are 13 more days to go. So my question to you is that, understand that there is a war going on, understand there is a crisis about oil supply, etc. Why FIIs are leaving, continuously leaving Indian stock market? Are they really panicking about fundamentals or valuations right now because of this war? So what is your take in particular about FIIs as of now, if there is any?
So there are two aspects to this. So first is that we tend to look at it only from our perspective, right? And for us, this looks like a very large pullout, right? But if you look at it, right, they will come to the reasons why FIIs have been pulling out from India for quite some time now, right? But right now, they are pulling out from all risk assets, all emerging market assets. So we are facing the brunt of that, number one. Number two, if you see the relative impact of this particular geopolitical situation, it has a heightened vulnerability for India because of the Hormuz Strait being involved, right? So I would say that rather than look at it and say that, oh, they are apprehensive about India as such, the fact is that at this point in time, and one final point I want to say about FIIs, we tend to think of FIIs as a monolithic one institution. Okay, it's not. First of all, there are as different amount of FIIs as there are different amount of retail and institutional investors. Number two is that FIIs are not entirely in control of their money because ultimately they are all fund managers of investors' money. There are a few like a sovereign wealth fund or maybe a pension fund which has the corpus and they're choosing to deploy. But that's one portion. At last count that I saw, it was about a quarter of the total FII flows was this long-term proprietary money. That is, belongs to the country or belongs to a pension fund, which is not dependent. But the rest of the 75% is actually HNI and retail investors' money, which they are deploying, right? So when you now then look at it, what is the nature of this? So there could be an FII who manages an all-country world fund. Okay, there could be a fund manager who's managing an emerging markets fund. And there could be a fund manager who's managing an India dedicated fund.
Right.
Right. Now, depending on the money that the investors are pulling out, he is forced to sell. So from an all country world fund, whatever India's share of the ACWI index, all country world index, in proportion to that, he may be overweight or underweight. That's a different chapter, but he has to sell from almost all his markets proportionately. If somebody pulls out from an emerging market fund, India's today's share of the emerging market index is about 13.5%, which means for every $100 that goes out, $13.5 has to come out of India. And if there is money flowing out of his India fund, he has no choice but to sell. So for us to take a look at the FII and judge him, you have to look at the investor behavior of the people who have invested in the FII's funds, right? And naturally, at a retail HNI investor level, he will look at it and say, in this crisis, what has happened? Crisis has happened around the Gulf region. So an American investor or a European investor says, let me take it all out from Asia. So it is a human emotion at play there. The FII is only a pass-through vehicle in such cases. Apart from that, there are active FIIs who are choosing to sell more of India in their active fund than of other countries, right? So it's what I wanted to say here is that the reason this is spiked is because investors are panicking in a geopolitical situation into a safety asset. And the definition of safety asset has changed now. In the sense, gold was the traditional safe haven. But because gold has had such a strong run up already, it is not an automatic attraction to investors to put more money into gold. So one of the questions which you might wanted to ask me is, why is gold not behaving the way it normally does during a war? That's because at this point in time, gold has already run up. So they don't perceive that safety in gold now. They have been putting money in gold for a lot of reasons. But today, the dollar has taken the place of the gold. So money is moving to dollar, and within in dollar, it is moving more to the debt in dollar. Because the US government itself is borrowing at 4.2%, 4.3%. So when you're getting a risk-free asset at 4.3%, and you're putting money out into a country, an emerging market like India, there is a risk of currency depreciation taking away your gains. So if you take a normalized depreciation of even 3%, he would need an 8% return just to break even. So why would he want to do that? So what I'm trying to assess here is that this particular month's heavy sale is not all because they have taken a negative view only on India. It is because their investors have taken a negative view on risk assets. Then, according to them, they have put money into the equity market in India, but India is in a more vulnerable situation in this particular situation because 85% of the country's oil requirements are imported. And most recently, 40 to 45% of that was flowing through the Hormuz Strait. It was earlier 60, 65%. So when almost half of our oil is jammed, there will be repercussions on the Indian economy, fiscal deficit, current account deficit, inflation. So naturally, while they are trying to figure out the actual impact, they would rather park their money in a safe zone, which is the dollar debt, and then choose to see once the dust settles after the war, to see how has India weathered it, has the impact been as worse as they thought, and come back. So I would not. So the point is that we tend to look at it from our own past history of FII flows and say this is the worst month. So many other countries are also experiencing the same worst month, right? And us. So I will say that this is the smart investor behavior by the investors outside India and the FII, right? And when the situation normalizes, they will again evaluate India like any other asset class. They have no love gained or love lost for India. There is no, particular thing कि मैं India को ही मारना है और India को ही बेचना है. No, it has been the sense of a panic situation. And finally, the war itself has turned out to be more protracted and long drawn out than initially assumed. We all thought that America plus Israel combined, the kind of firepower they have, and Iran being isolated in the region, that it will be a quick and easy war. But those hopes have been belied. The war is dragging on because Iran has obviously got defenses buried so deep inside their mountains that all this attack has still not completely wiped out their arsenal, and they are still carrying out attacks. So I think that there was an underestimation of the war itself initially. But now that is prolonging, there more and more investors are tending to choose safe horizons like the US dollar. So I think that's the way I would look at it. And apart from this, there has been a consistent FII selling over the last 18 months, right? That is also continuing now because that situation has not changed for the better. What is that? One was Indian valuations. Second was India's perception as a non-AI ready country. So these two fundamental factors have not changed. And you might ask me, if the market has corrected so much, why are we still talking about valuations being expensive? Because we are only looking at our valuations against our long-term average and saying that they are now below the 10-year average, below the 5-year average. But on a relative basis to emerging markets, because other emerging markets have also corrected at this time, we are still at a 50% premium to emerging market valuations, even after this correction. India has corrected a little more. So from a 60% over valuation, we are now at a 50 to 55% over. But we are still not a cheap market on a relative valuation basis. So, and AI readiness, the 4-day AI conclave has not done anything to change the perception of our countries and our companies that we are not AI proactive. We are AI reactive and we are playing catch up, and we will get some portion of the AI business as a fallout, but we will be downstream players. We will not be the upstream AI driving country or companies. Those two things will take a long time to go away, and hence that portion of the FII money which is saying that this is the time to bet on AI, and this is the time that for me, a country with AI readiness, which is valued better, is a far better bet. The war has not changed that situation. So that level of FII selling will be continuing. And this geopolitical selling is a layer on top of that normal selling that the FIIs were doing.
I think that's a very good insight. And I think quite like the point that you made around the valuations that, we keep comparing last 5 years, 10 years valuations. But if that's the case, and if FIs continue to sell off India, right, from whatever pace they were selling previous to the war, let's say if that pace is maintained, right, then no matter how much of DIs flows go into the Indian market is not going to see a sharp recovery back to or a relief rally or like 15-20% of rally, because both the conditions that you mentioned, one is the AI readiness. So we're not going to be AI ready in, I don't know, 6 months of time frame. It will take us few years, even if we start focusing on AI now. So that's not going to happen immediately in next 6 months or so. And the second point, the valuation, if we're still at premium versus the emerging markets, then that would warrant more falls in Indian stock market. Do you think that then we are likely to see more falls in Indian stock market from here on?
So a couple of points that I wanted to say that. So we also, again, we are tending to look at it from our perspective, right? So why I'm saying this is 2-3 things that we need to be aware of the world outside. Now, the world is going, before the war itself, was going through a reaction phase where the AI bubble was looking like it's going to burst a bit. And what was triggering this move, if you recollect, before this, it was the Nasdaq was correcting a lot, even before the war, right? What has triggered that is that this AI is like the California gold rush. There's a huge, that everybody is out there digging sand in the California sands to find gold, and everybody is going there. But the sad part of it is that there will be only a few winners in the AI race, right? And what has happened is that because it's now caught everybody's fancy, the top 5-6 technology related companies, I'm not calling them technology companies, the Googles, the Microsoft, the Apples, technology related companies are investing close to $650 billion in AI related capex, all in search of that holy grail to get that thing right. Now the market is worried that if every one of these biggies is putting, and what is $650 billion? Reliance's market cap is $200 billion. So in 1 year, just the top 5-6 companies are investing 3 times our largest company's market cap in just AI capex. So market is saying which one of these is going to click and what is the return on investment on this massive expenditure, and has started punishing those companies. So what I'm trying to say is that the AI also has run up so fast that you can't assume that the AI thing will remain forever. So somebody else described it perfectly. India is the perfect AI hedge. So the day the investors feel that AI has now become too much of a bubble and too much expectations have been built around this, just like the dot-com bubble or whatever it was, at that time they will seek a zone of non-AI readiness, and India could be the perfect recipient of that money. That's number one. Number two point is that when this AI bubble cracks, the very markets against which you are comparing, right, will tank, and their forward earnings. So one more thing on the valuation part, which I should have mentioned in my previous answer, is that we are looking at the trailing PEs and comparing with the historic PEs. But all fund managers look at the forward PEs. Right? So on a forward PE basis, right, if you look at it, India is still overvalued. But on a forward PE, because prior to the geopolitical situation, our earnings scorecard for the quarter indicated that for next year, we would have a 12 to 14% kind of earnings growth in the larger cap space, and probably mid teens to low 20s in the small and mid cap. So there was a U-shaped recovery in earnings coming forward, and hence India's forward PEs had dropped significantly before the war started, right? And then, so if you have noticed, just before the war started, there was a little bit of FI flows coming into India. And the selling had dropped because our forward PEs, in the context that we signed the Europe trade deal, right? The US trade deal, of course, became infructuous because of the Supreme Court decision, but we had a good budget. So what I was trying to say was our forward PE was beginning to look better, right? Now the valuation situation is that this oil-related impact, how far it's going to affect earnings for FY27 is not yet clear. So when that clarity comes, and if this geopolitics is seen as a short 1 quarter effect, and that after that Indian earnings would come back to the promised trajectory that was seen during the guidance given in the previous earnings season, India's valuations will look a little bit better. At the same time, the other countries, because the AI bubbles bursting, like a Korea, like a Taiwan, their forward PEs could be readjusted now to take off the growth rate they were earlier expected, and they could now little bit become more expensive. So this valuation gap could narrow for reasons not in our control. So what you have pointed out is a very good reason why valuation won't fall, because DIs will keep buying. So the price will never fall to a level of value because DIs are buyers. But other countries' valuations could take a bigger hit than ours, and hence that gap could get better. That is, India's overvaluation could come less. So I'm not that pessimistic that, oh, we will never become AI ready and available. No, that's one. The other aspect here is that if you see, you mentioned the FI number for this month. Take the DI number for this month. The DI number for this month, right, has also been historic.
Agreed. Totally agreed.
So they have put all their resources. My point is that, will the DIs have that much money left? Because you're already seeing that investor flows into mutual funds have been shifting into gold. Last month, again, it came back to equities, but it's still about 25-30,000 crores only. This month, DIs have put more than 70,000 crores into the market. So if they're getting only 35,000 crores in mutual fund, and maybe PMS, AIF, and insurance gets a little more, can they sustain the 70,000 crore a month's buying? So I'm saying that, so since DIS will also have their constraints, and then they will have to do sector rotation in order to buy something which looks attractive, they'll have to sell something else, right? We could see that the markets could actually be a little bit under pressure, because that level of DI buying which came in this month will not sustain forever, because investors' flows are also tapering to the 25 to 30,000. Our SIP book is about 30,000 crores, right? But there are lump sum redemptions. So my point is that it's too early to say that, call out the bad news, right? It's an emerging situation. It will develop, right? And oil has this peculiar impact that it's always a V-shaped move. So when it rises in a V. When it falls also, it falls in a V. So why I'm saying the perception of India, if the war comes to an end, which is a digital situation, right? It's 0 or 1. The war ends, doesn't end. If the war ends, the same oil-related asset which got a severe hit would see a severe bounce, because oil will drop as fast as it rose. So I'm saying the situation could be very different a month from today, where oil is trending back down towards $80. And let's say, oh, so the fact that we factored a $105 oil price into Indian stocks, now it's only 80, will certainly make them look better. So what I'm trying to say is there's a lots of delicious things out in the buffet there which could decide the way forward. So to sit and say that, oh, it looks all bad and negative is not right. It's a blending situation, it's an evolving situation. And one rule of the market is that which goes up has to come down, that which goes down has to come up. So if you are consistent there, right? Because especially given the way the oil is reacting to a particular situation. See, the demand supply situation on oil, I'd like to remind everybody. Before the war started, the International Energy Agency had predicted a 3.5 to 4 million barrels supply excess of oil by the year end. So, why is that situation going to change if the Hormuz Straits come back to normal? In fact, oil demand may be less because of the whole situation around the world trying to go into a slowdown because of the war impact and all that. So, I'm not that. All I'm saying is, in the short run, it's going to be volatile. When the war ends, it'll be back to normal. And a back to normal India was an improving India. Let's not forget that.
No, this is brilliant. This is a brilliant summary because I was going very pessimistic listening to your first response. But then, yes, I think you rightly said that there are a lot of variables up in the air, and it's extremely hard for anybody to assess the exact impact on Indian stock market. So let me now ask my question in a different way, Sunilji, right? Let's consider two scenarios, okay? Because ultimately everything is dependent on how long this war stretches, right? So let's say situation one or scenario one is, let's say the war finishes, and as you rightly said, it's going to be either 0 or 1, right? So let's say the war finishes in the next few days, okay? It could be 10 days, 15 days, 20 days, let's say, okay? That's scenario number one. So if that's the case, where do you see the markets, Indian stock market? Because that gives you something to assume, right? That gives us something to say that, okay, then there is only 20 days of uncertainty in the market, right? Scenario two is that, let's say, you know what, the war doesn't end in the few days and it drags for a few months. It might be 5 months, 6 months, 7 months, okay? It might be looking like towards the end of, 2026. In both scenarios, if you were to give us a very top level view of Indian stock market in terms of, more falls, or do you see recoveries? How will the Indian stock market play out in that case?
I think it's a plus or minus 10% from a larger cap index perspective, right? A short war could see a bounce back of 10% in the index within a month after the war ending. And if the war stretches, I see a 10% downside from the current levels if it stretches for 6 months. So I would say that it's a tunnel with 10% on either side. So from 23,500, you can do the math, right? So you add 2,300 to 23,500, or you subtract 2,300 from 23,500. So you're then looking at a 20,000 bottom to a 25,500 top, right? It's at the broad band. So the range is actually 20%, if you say, plus 10, minus 10, is where I see the impact. And the reason I put a broad 10% around it is because you see the war situation bouncing back, right? Which means that a lot of the cloud around India goes away because oil was one which was hurting, no longer going to hurt. And diplomatically, you have to compliment the government on the way we have managed the situation. See, we've been talking to Russia all through, we've been talking to Ukraine all through, we've been talking to Iran all through, we've been talking to America all through. So we have managed to keep all balls in play without taking sides. Now, obviously, from a political person, somebody will say you are being vacillating, you are going back to the non-aligned movement, whatever. But I'm saying that practically, we are in a situation where our economy has been relatively the same. Russia, on account of which we got a 25% extra penalty, today they are removing sanctions and say buy more oil from Russia. So what I'm trying to say is our diplomatic efforts. What I'm saying is, as a country, right? So from a stock market's perspective, right? This hit due to oil, if that primary focus goes away, right, you will see a change in the perception of those investors who pulled out money from their India-oriented funds. And fund managers will have no choice but to get back that in, right? The second aspect is that, I will say, is that passive funds are a big player in the market, and India gets hit with the proportion of passives. But the way I see the correction scenarios that have been happening around the world, I expect that our share in the MSCI Emerging Market Index should actually go up because it's been coming down dramatically from a 16% to a 13%. But all of this correction and all of that reassessment and all that, now I think that the next time this index gets reassessed in terms of its weightage, India should trend up. That will automatically lead to a bunch of flows. And that will happen if the oil related, because that is there in the index also in terms of the computation. So that's my reason for the positivity. But on the stretched part, because when this stretches, how long can the corporates who are suffering the crude input prices hold off on their EPS? So right now, 1/4 of EPS, सात खून माफ नीचे हो गया. But if it's 2-3 quarters, then you're rewriting your FY27 numbers for a lot of companies, right? And hence that rewriting will mean that there'll be sector specific selling coming in. And so that could drag the markets down, right? So that's why I put that as a 10% kind of a caveat from where I'm saying that, right? And the other point I want to make finally on this point is that look, the expectation of people that only oil related sectors would get hurt because of this war has been proved wrong. Because one of the sectors which has fallen the most is the banking. And that's why my very first answer is the answer to that, is that it is an India sell-off which is happening. So the banking sector is 35% of the India index, whether it's the MSCI India index or the large cap index here, it's about 30 to 35%. So it's borne the brunt of that. So when that India risk sentiment goes off, the reason I said 10% bounce back is because that sector, which had nothing to do with oil, just faced the heat of a sell India. Okay, so I'm just saying, so when sell India moves to not sell India, but may not need to go to buy India, automatically that restitution will happen to the index level. So that's my logic of putting a plus or minus 10% as a broad tunnel within which I think the market will act and react.
So essentially what you're saying is the bottom could be, I mean, if the war stretches, right? That's the caveat, or that's the condition. If the war stretches for a few months, 6 months, 7 months sort of a time frame, then we cannot rule out the possibility of Nifty going to 20,000 level, right? That is still out there because of the EPS, problems or, challenges or, detrimental impact to EPS in the next 2 quarters or so.
Yeah, it's not just the EPS impact, it's the cascading impact of what happens to the government. If the government is keen to meet the fiscal deficit, a prolonged surge in oil prices, how far can they ask the OMCs to pick it up? How far will they cut excess duties to pick it up? Then what happens to their budgetary spend? Then the government capex expenditure, will they cut that down? Because that is the non-critical one. Though it's very important for India, the multiplier effect of that is very important. So you'll get a reverse cascading impact if the war stretches. Because we have 74 days of oil at the beginning of the war, right? That was the story being told, right? So that 74 days is 2.5 months. What I'm saying is that if you stretch longer than that, then we are coming to a situation where supply becomes an issue and not just price, right? And then so many industries which suffer, like even this one, you'll see already LPG cylinders are being curtailed for the commercial establishments,
right?
Which means restaurants are already cutting down their menu. When I went to a restaurant yesterday, he said, I'll give you only these items, sir. Because of gas, I won't give you the other items. Straight, blood, straight to the face in a restaurant. And the second aspect then is that they are forced to raise prices. And that will then hit consumers. And then consumer surpluses will come down. So the longer it stretches, it's like it's a multiplying effect on various parts of the. So you'll see that right from consumption to inflation to whether RBI will then consider a rate hike. So these are the frightening possibilities which come in if the war drags on, right? But at the same time, it's important not to scare people who are listening to this podcast, because what I'm trying to say is there's a probability factors you need to assess. So when you say 20,000 is the worst case scenario, I would put not more than a 5% probability of that happening. Okay. So it's contextual to that, rather than people say, oh, can go to 20 if I panic. The point is that there's a probability associated with various events, right? And so both the tail end risks, right, I would say are only 5%.
Right. Okay. Understood. Very clear. I think that context is very clear, that the probability of this happening is very, very low, but you cannot rule it out as such. There's a
and the reason for that also, Rahul, I'd like to point out to people is that the person who's getting hit most by the oil price hike is not India. This is the United States of America.
How come?
Because their gasoline prices are not controlled.
what's the impact of the oil prices and the gasoline prices?
Huge. Huge. I mean, gas and oil are the same. And the international prices, in fact, for the first time you see the Texas light crude and the Brent crude, it has narrowed. Earlier, there was a huge gap between the Brent crude prices and the gaps. Okay. Now it's narrowed down. In fact, for some point of time, it was equal. Now,
Right.
again, it's widening. But so what I'm trying to say is for the US, inflation, Trump's popularity there from a perception of what's happening.
Yeah.
His ability to force the new Fed head to cut rates in a time when gas prices are rising will be very low. So the
Right.
pressure on America to bring the Hormuz Strait under control and oil under control is much more than us as a user industry.
Right.
So what I'm trying to say is that war to stretch, what they will do, that's it. He will probably try and take control of the Hormuz Strait in some form. So the war can be in two parts. He's already moved about 2,500 troops on his ships close to Iran, and he's already attacked their oil terminal island, the Pearl, Golden Pearl, or whatever they named it, right? So one of the things that Mr. Trump could do, and that's why the beauty of his uncertainty comes in, is that he could go and capture the 100 kilometers around the Hormuz Strait and say, let the rest of the war go on. I'll take charge of the Hormuz Strait. I've destroyed their navy, everything. I'll take. So that could be a very funny way the war develops. The war could continue, but Hormuz Strait could go out of Iran's control. Possibility. With Trump, you can't rule out any possibilities, you see. So what I'm saying is that when you say that, then if oil is under control, but the war is going on, it has a complete different implication for India.
Right.
Because our main concern with the war is the oil prices and not necessarily the war situation itself.
Right. Okay. Understood. Sunilji, I think this is a very, very good insight that you have given us. Now, I want to move into the opportunities in this market, right? So traditional wisdom tells us that when the market is correcting and crashing and, there are a lot of fears, this is a golden opportunity to buy. Typically, that's what is said, right? Now, I want to ask you which sectors, for example, or which pockets of the market right now looks attractive to you from a risk versus rewards perspective?
So there are two aspects to it, right? I would broadly polarize the market into two parts. One is those affected from a EPS perspective, future EPS perspective, by the oil-related turmoil, and those which are not. Okay? And one would say that those which are not should have fallen less than those which are. Right? But in the market, that's not true because of the way the index is weighted. Right? So what I just spoke about a few minutes ago in terms of the banking and financial services sector. They're not directly affected. One would have expected to fall less than an oil-related sector like a paint or a tire or aviation, but it's actually fallen a lot, partly because of the passive selling taking out a chunk of the market from outside, because international flows are much more passive dominated than domestic flows. Domestic passive is still 17-20% of the total flows, but internationally it's probably double of that. So the international FIIs sell-off has been concentrated a lot towards the banking sector, purely because investors pull out money from a passive fund, it has to take the brunt. The second is that there has been also concerns around the fact that this inflation spike which could occur could make RBI to not do a rate cut. And there's a small minority of people who actually think that a rate hike might be warranted. That's a separate for a discussion on whether that happens. I have a different view. But I'm talking about the market perception, the market fear that RBI could actually slip into a rate hike, right? That has hurt this because already G-Secs have crossed 6.7, 6.8%, close to rising. So a lot of the banks hold a lot of compulsory G-Secs because the SLR requirement is there. But on top of it also, they do place their money there. And so the mark-to-market hits on their immediate profitability could be there. Second is, if there's going to be an economic slowdown, then banks would take the brunt of it. Second aspect. The third is that the Nifty Bank Index, along with the Nifty, is one of the most traded from an F&O perspective. Right? So when somebody is selling India in the cash market, they're selling a stock or they're selling the index if they're a passive. But when you are then trading in the F&O, whether you do in the Nifty 50 or you do the Nifty Bank, These are the well traded. So in the Nifty 50 itself, there's 35% bank, but the Nifty bank is 100% bank. So all the action on the F&O market has hurt this segment very badly because they are the only two liquid indices available for F&O trading. We don't have any other sectoral index where F&O is a big play. So banking has borne the brunt of this sell India kind of a thing. So to me, then when one builds a portfolio, right? I'm going to answer this question only for a medium-term investor. Okay? Because first of all, a short-term investor, there's no such baby called short-term investor. A short-term is a trader. He's not an investor. Okay? So the market uses these terms, short-term investor, long-term investor. For me, an investor is somebody who is basically attempting to take advantage of India's growth story to get inflation beating returns, right? That's the simple definition of an investor, right? So when you then say you're depending on India's growth story, then regardless of how long the war takes, market has to come back to the fundamentals of the India growth story. So my recommendation, even through these panicky times, is to stick to what is the India growth story going to pan out after this geopolitical oil-related crisis goes away, right? And bet on that. So, and whether that may have corrected more or corrected less should be irrelevant because in the long run, whether a market corrected 20% today, so if you know, for example, whether you invested in the peak of the market or the fall of the market around 2008 global financial crisis, peak was 21,000 Sensex, bottom was 7,000 Sensex. It doesn't made hardly 2 percentage points per annum difference to your return over the next 15 years. So it doesn't matter whether you're buying something which has corrected more today or not corrected in the context of this, but buy that which will show strong EPS growth correlated to the Indian economy's growth, which should come back to its pre-war level when the war ends. So pre-war level, what is the situation? Pre-war level was 6 months prior to the war, it was a depressing scenario because we had 50% tariffs slapped on us. We were scrambling around the place in terms of how the growth story is going to pan out. And then what happened? The Indo-EU trade deal got signed, right? And then the US trade deal also got signed. The trade deal may not be in existence today, but the point is that the US was willing to sign a trade deal with India, which means that after the war ends and everything comes to normal, they will be willing to sign a trade deal with India. The perception of India-US relationships has undergone a dramatic shift. When Mr. Trump called us a dead economy, it looked like India-US relationships were on very troubled situation versus the deal got signed. Then the Supreme Court, US, was nothing to do with us, right? And we'd be foolish to go with an 18% deal when we're getting 15% tariffs because of the Supreme Court. So I believe that in the medium term, I don't want to put a time frame to it, India would be getting back a favorable US trade deal on ground, just as it was before, right? The 18 may be to 12, it may be 15, whatever. I am not getting into that. But what I'm trying to say is, so in the context of India having trade deals with the two biggest blocs in the world, right? So one is almost 30% of the world economy. Another is about 25% of the world economy. So more than half of the world economies, advanced countries, you're going to have a trade deal, and that's going to decide India's future. So what is that trade deal going to mean? It's going to mean a big boost to our manufacturing. Right? So I would say from the medium term, you focus your energies around the manufacturing because the manufacturing will lead to jobs, will lead to consumption. All of that in the medium term is a secondary play. Okay? But first, the manufacturing cycle has to pick up because if we are to make those trade deals effective, we have to make goods that those guys want to buy. It could be in partnership with MNCs from those countries who come here and set up factories here to take advantage of our low labor costs and the government policies like with an extended PLI scheme. So I'm saying the future of India lies in our shift into manufacturing. Right? So to me, that's very clear. And banking is a layer on top of manufacturing because no manufacturing can succeed without financing. Right? So to me, banks plus manufacturing are the two stories. So in the short term, there could be a consumption pickup because the GST has not yet played through fully, the cut. But that's a short-term pop. The longer-term consumption play bounce will happen only after manufacturing gets a good, strong wicket, new jobs are created, and then there leads to a consumption because there are more people earning money, correct? So consumption will come later as a second wave. The first wave may happen later this year because the GST cut will play through, but I'm not talking about that. For me, then you should keep your eye clearly focused around anything related to the manufacturing field. It could be right from building materials to metals which go into the manufacturing part to all kinds of stuff. And the key point there is that so those are essentially how would you play those, right? Because it's a very wide playing field. But clearly the answer lies that it's a more mid and small cap oriented tilt because manufacturing is more of a mid and small cap play rather than, in fact, there's a lot of manufacturing play outside of the stock market in the SME and the MSME sectors. But that's the play which you have to play and look at it and figure that out. So I would say that, and to the extent that anything there has got corrected, it's a golden opportunity to buy something which is cheaper than it was a few months ago.
I think banking, I totally get it. Manufacturing, as you rightly said, that this is quite a diverse field, right? I mean, auto is also counted in manufacturing, for example, right? And I can look at manufacturing from two angles. One is manufacturing that is catering to Indian population versus manufacturing that is catering to export related businesses, right? And export related businesses have all kinds of risks right now because, of course, of the shipping lanes are blocked. But even if the war gets over, I mean, the problem that I face as an investor is that I don't know which side of the bed Trump will get up tomorrow. And he might do another, bizarre thing that the world has not factored into. So when you say manufacturing, and there are sectors that have been down because of the export oriented, export have been dropping in the month of March, if you look at the last few days, right? So would you still go out with manufacturing which is export oriented, or would you rather focus on Indian, story-based manufacturing sectors or segments?
No, I think it'll be purely export-oriented manufacturing is the way to play it.
Right.
Okay, because Indian manufacturing is still lower-end manufacturing. The value of the goods produced to sell to the Indian population is 1/10 of the value of the goods you will need to supply to the advanced countries.
Right.
So there could be a time frame needed for it to get back on track after the war ends. But be patient through that because you are there to create wealth in the future, not in the next 6, 8, 9, 12, 1 year. No. I'm saying that there will be. So don't expect this to immediately deliver returns to you and come back to me in 6 months and say, you said manufacturing hasn't gone anywhere. Right. It will not go anywhere because it takes time to come back. But I'm just saying is that you're building for the long term. So the market's principle is very simple, right? Buy low, sell high.
Yeah.
So don't go and buy something which is already high. So the point is, second element is that it's precisely what you said is keeping investors away from manufacturing.
Right.
That uncertainty. But it's the long-term investors' ideal playground to feed off this fact that it's an unknown to a short-term oriented investor. So he's unwilling to take that bet on it. But in the long term, we don't have a choice as a country, right? With the amount of population that we have, the demographic dividend will easily turn into a demographic curse if we don't actually get jobs for them. And no amount of domestic is going to provide that level of jobs because with a $3,000 minus per capita income, right, you cannot produce enough profits to feed the people of India. Okay. You need to sell to the $90,000 per capita income US markets or the $60,000, $70,000 per capita income European markets to be able to deliver that value addition in the margins, right? From which you can layer off. It's the same old China story which China played then. We have to do this in a much more slower way because we are not authoritarian. We are a democracy. It will take time. But all of that behind us, I'm just saying that as a medium-term investor, right, your focus has to be on looking at the thread. Where is India headed? India has no choice but to give job creation opportunities to its population. Otherwise, the governments in power will lose the elections. So ultimately, the politicians drive this. So these are the hard facts. So what I'm trying to again stresses that from a medium-term investor's perspective, right, banks are the blood circulation which will keep the wheels of the economy going, right? So they will definitely benefit manufacturing or from consumption. Even consumption, it's through EMI-based loans only that consumption happens,
Yeah.
right? So
Agree.
banks are an ultimate beneficiary, but I would still would say that from a medium-term perspective, consumption will go through a wave. It will see a spike this year because of the GST playing through, GST cuts playing through, but it may go through a lull until the new wave. But it's manufacturing which will have to step in and do that.
Within manufacturing, so which businesses export oriented that you would say? For example, is it textiles? Is it EMS? Is it pharma? I don't know. I mean, where would you say is the attractive valuation versus the earnings growth likely to be?
So I would say that see, textiles is still a low end play. We are just margin. We are just drawing cheaper products. There's a
Right.
very limited. I mean, the Gap or Banana Republic may sell their products at very high value, but what he pays to the Tirupur Hosiery manufacturer will be plus or minus 10% more than because he
Right.
knows his cost breakup better than the owner himself knows it. Walmart or whoever buys that. So it's a low end. It's important to provide jobs. It will keep going, but it's not the extra delta that you will get, right?
Right.
We have to move into sophisticated high-end manufacturing, which greater components are there in the EMS part and definitely in pharma.
Right.
Because I think pharma, we have a very wonderful opportunity because it involves skilled labor.
Right.
Whereas textiles and leather and gems and jewelry is largely semi-skilled labor.
Right.
So you
Right.
got to look at the components where you need the skilled labor.
Right.
And obviously in pharma, you need skill. In electronic manufacturing, you need that skill level, high level. So I would back the skill-oriented areas of play in
Right.
terms of
Okay.
this.
No, this is really helpful. What about IT? So, a lot of people have different viewpoints on IT, Indian IT per se. The lack of AI, the lack of innovations, and now the valuations or the index is down, I don't know, 40%, maybe more than that. I've stopped tracking it for a while now. But what's your viewpoint on Indian IT? Is it a buying opportunity in Indian IT stocks, or do you think keep away from it because this change that is happening now is a structural change? Therefore, Indian IT stocks have got a long path to come back to recovery.
So, yes, first of all, yes, there is a structural change. Okay. So, in a structural change, valuations don't make sense.
Okay.
You cannot predict the future valuations because when the structural changes, you don't know. Second is in a structural change, there'll be a few winners and definitely there'll be a few losers. So one can't predict those based on any past performance history.
Right.
Okay. So unpredictability of the winner in the future is there and structural change because from a pay per employee per hour to a pay per project. So companies have to redesign it to say, I quote this much for the project. Whether I use AI, whether I use people is up to me. But I'm giving you a deal. But you can't go and say, I'll need 100 hours of labor for this. And so I'm billing. So the entire billing mechanism. So there is definitely a business model change.
Okay.
Okay. That's one thing. But for that reason, I don't get unduly pessimistic about IT. Okay. So I'll tell you why. So two things there. One is I believe that India will be the downstream player in the AI world. We will not be the upstream AI generator hardware, that kind of a thing, but we'll be the downstream. Means what AI will lead to, right, is two big opportunities. One is in terms of AI affecting the entire buyers of IT in the world.
Mm-hmm.
We are focused on IT companies themselves suffering this business model change. But if you look at a manufacturing company in the US, you look at a consumer company in the US, look at a bank, AI is going to hugely affect their businesses. But they need an AI consultant to guide them through and implement that project to switch from a labor-oriented to an AI-oriented company. That job is going to be done by Indian IT companies.
Right.
So that's a whole new business opportunity of AI-related consulting, right? Because every industry in this world, AI is the new industrial revolution happening, right? So every industry, there's no industry which will not be touched by AI, right? But each one of them needs the advice, needs the implementation, how to cope with it, how to manage it, right? So AI consulting is going to be the huge, and like I said, that's a huge opportunity for Indian IT companies. But how fast they adapt, which companies will adapt, is again $1 million question. But that's a huge new business opportunity which IT companies will get. That's number one. Number two is the data center related work. So if you see, India has already given till 2047 a tax-free status for people to come and set up their data centers in India.
Correct.
Right? Now, who will they do it in partnership with? These big MNCs worldwide. It will be the Indian IT companies because they know how to manage the Indian labor, how to do that. So the downstream of the data center work is a second big business opportunity for the IT sector. Right? Now, both these opportunities may not be as profitable as their existing, squeezing the thing out, right? Where, all their costs are burned, is just service. So their profit margins will definitely not be as great as their historic businesses. But these two businesses will come in and substitute. So obviously the IT companies will go through a phase of attrition. They'll have to lay off their people who are not fit enough for these new lines. They'll have to hire new people who will be fit into this. So there'll be a lot of churn in the workforce and all of that. And those, again, who will adapt faster, who will recognize AI as a threat and not recognize, all of these are $1 million questions, right? So that's one. So at the same time, I also think the market is overdone in a third aspect on IT, which is the level to which this AI will take away their existing businesses. I believe for the next 2 years, the growth rate of their businesses will come down, but it's not like they're going to collapse. Because the user companies are also not all going to be on the same level in terms of wanting to switch to AI and substitute an IT company. Like the threat which happened with Anthropic was what? He was going to set up this whole thing on the desktop of the company. So they said, why should they hire an outside IT company when I can do it myself? But how many companies are willing? Because with an IT company, you can question, you can argue, you can say you didn't do your job, you can fix the accountability. If you put it in-house and you don't have any skills to manage that, something goes wrong, who will do it? So I don't believe that it's just going to come and kick out this whole software as a service or the SAP consulting completely. And it will take time. So in 5 years' time, you can say a massive change will occur. But over the next 2 years or something, I think that the growth rates will slow down, but their core models will still continue to throw up cash, albeit at a lower margin. So there is no threat of these companies suddenly dropping off from a profitability angle. They will continue. So which means what is that I believe that their valuations, like you mentioned this 40% correction, right? The valuations are definitely looking more reasonable, right? And so from that point of view, my final take on the IT is to put yourselves back into 2019. Now, why 2019? Nothing. It is pre-COVID. How was IT pre-COVID treated in the markets? It was a safety sector giving steady compounding returns in a dollar-based revenue so that the Indian depreciation automatically benefited the rupee EPS. And so it was a safety pack. COVID came and changed the thing dramatically for IT because suddenly you talked about Internet of Things, work from home, people, everything coming to home. So IT companies, consulting work will, dramatically go up, everything. And IT became a growth sector post-COVID. Right? That fundamental model changed and hence their valuations spiked up because they got a growth-oriented valuations as opposed to a safety-oriented valuation. So now we are regressed back into 2019, where IT is now back again as a value play, as a safety play, which has the same benefits of rupee depreciation, giving a comfort of 3% per annum earnings growth just because of the currency, plus some steady state business. So what I'm trying to say is, so IT in an investor's portfolio now shifts from the growth part of the portfolio to the value part of the portfolio. And this has to be done by every investor in terms of their portfolio allocation, is to see what role is IT in it. As a sector, if you had taken it as a growth sector, then you have to change it and put it in the value place and then see based on your risk appetite, how much value you want, how much growth you want, right? And it will get its rightful share there, okay? And this move to value will attract a whole set of new investors into IT today who had gone away from IT post-COVID. This is the long-term income-seeking investors because the dividend yields of the Indian IT companies has suddenly almost doubled. right? So there are pension funds and insurance funds which want a good dividend yield on a stable company. When IT became a growth, they actually got worried about it. And IT was actually now part of a growth. But for these people, it was not, because when the growth went up and the prices went up, dividends didn't match up. So dividends dropped to 1.5% dividend yield. Today they are back up to 3.2, 3.5% dividend yields. So you will get a new set of investing class from abroad. Largely these are from abroad, right? Who will buy into IT as a value play, as a dividend play, and that will give support to the price. So that in summary is my view of IT. That the IT of before the current AI craze is no longer the IT. The IT is now a value-oriented, steady stream of revenue, a steady stream of dividends, value-oriented play. So every investor will have to look on. Some investors might have to increase their allocation to IT because they are value-oriented investors who are very conservative. Because I don't see much of a fall further for IT. Because, like I said, this dividend yield attraction will get in a set of investors who will provide a kind of a floor and a base. So I think that's my summary of the IT situation.
I think this is brilliant summary that you are calling out IT as a value play now, which is excellent. Just to throw my 2 cents again, I'm no expert as you are, Sunilji, but I'll just still throw my 2 cents, which is I think it all depends on the attractiveness of other sectors as well, right? Because pre-war, just 15 days back, when bank Nifty was crossing 62,000 versus now it has come down to like 53,000 or 54,000. That has all of a sudden, to me, have also changed how much of allocation one would want to IT versus banks. Again, it comes back to that question that relative attractiveness of various sectors is changing so fast, is changing rapidly because of this war situation that, sitting on just one bet and just saying that, I'm going to sit out, it's quite difficult because all of a sudden you feel like, gosh, if I allocate 20% of my portfolio going to IT, but what about now banking? What about now auto? That has fallen by 12-15%, and there may be more falls coming my way. So is it the time that rather than just sitting on IT and just letting it hatch its eggs, which may not happen for the next 2 years because of the growth, and another news come out of Anthropic that they have launched another tool or whatever. I think that's where, to me, also my mind is going that, it's not just about IT alone. It's actually looking at the broader market and see, I mean, small cap, for example, it's a broader index. And if it's down by 18%, I know the PE wise, it's still at 25, trailing PE, not the forward PE. And the earnings have been decent, at least in the Q3 numbers that I saw. So there is definitely a point here that do you continue to readjust your portfolio as the things are changing? And that brings me to my final question to you, which is 2026, right? There has been so much of volatility, not from a price perspective, actually from a fundamentals perspective as well. From an equity investor perspective, it's very hard to stick to one bet because things change rapidly in the matter of fortnight. What would you say to the equity investors for 2026? Is it that they continue to do that asset allocation of, don't just overly rely on India's story or US story for that matter? There are people who are saying 90% of my money is going to US because of the AI. And on the other hand, there are people who are saying that, what, AI is going to crash. So let me put everything in my Indian bucket. And then there is a gold and silver in the mix. So for 2026, how should one navigate through this? I call it worst year, not from a returns perspective, but definitely from uncertainty, definitely from geopolitics, definitely from trade deals perspective, and definitely from valuations and earnings perspective, everything mixed together. How should one navigate through this 2026? That's my last question. I know I've asked a few others, but hopefully get some meaningful information out of that as well.
So first, before I answer your question, let me tell you that I agree fully with you on what you summarized on the IT part, right? And that's precisely my point, that IT now changes from a growth play to value play. So you have to readjust your IT allocation up or down depending on your value situation. So I'm not talking about the what you call as the CARG, right? That is growth at growth at a reasonable price. That's different. Your banking, your auto, they are the ones which are coming into the guard for play, where I'm getting my growth much cheaper, right? But IT is not a growth play. So you can't compare IT with banking or auto or anything else today because there is no visible growth path for IT. It is only a value play. So you can't compare these two. I'm saying it's a different bucket now. So if you had IT as a growth play and had it as 25% of your portfolio, and you say, no, value only wants 15 in my portfolio, you have to get rid of 10% of IT. So it's not about the relative valuation because you're right that there is no visible growth path in front of IT today. That's the fact of life. But that doesn't mean the business is going to collapse. So I want to make that point clear that if you are a 100% growth investor, get rid of IT. However, nobody is a 100% growth investor. You want a margin of safety, which is there in IT. So I just want to make that clear that don't compare banking with IT. Banking is a growth play. Auto is a growth play, right? Yeah. So what price are that growth coming at is where you decide within the growth play, right? But don't put IT into that mix. That was one. The second is that when you said 2026, now there are two sets of investors for which I would like to answer that. So when you say how will 26 do, there's somebody who needs this money by December 2026. And there's somebody who's investing in 2026 for the future.
No, I think it's
so
all
which
about.
Investor are you talking about?
Yeah, exactly. So it's about investing in 2026, but actually looking at. So I'm not a trader. I don't trade, and I'm not investing my money for 2026 returns, right? I mean, that's a different question altogether. For me, it's like I'm investing in 2026, but for future. So it could be 3 years, 5 years down the line, sort of a bet.
Yes. The second aspect here is that person already has a portfolio which is now gone under water a bit, right? And so is that person of an attitude that he can put fresh money into the market, or he's saying, what do I do with do I redeem and get out? So again,
I think that is, to be honest, Sunilji, sorry to interrupt you, that is even a bigger question right now. Because people will ask me this question that Rahul, you're talking about investing more money or navigating through this. What do we do with the current portfolio, which is all in red right now?
Correct. So I think that you heard my answer to one of the media channels there, right? To an existing person, I would say, whatever cash on hand you have, right? You just replicate your pre-war portfolio in microcosmic amounts. I had mentioned 1% because the 3 months the war lasts, that's when your cash will get used up, right? I stick to that stance. In fact, I would actually advocate for a slightly more aggressive investor to actually do a reverse cascading, which is the market every 3-4% it corrects, you increase your 1 to 1.25% to 1.5%. The more the market corrects, the more you put in, but not everything at one go, clearly. So buy it in dribbles, right? And keep buying. Because when you mentioned that this is the worst year, 5 years later, you will say this was the best year for me. So the worst year and the best year are from which position you're looking at. Yeah. You're looking at, that's why I said, if you have been investing over the last 5 years and suddenly you need your money by December, then it's the worst year because all your gains you saw pre-war have disappeared in a wave. So suddenly you say, 5 साल में क्या मेरे को low double-digit return मिला? I could have put in a bank deposit instead. Yeah. So the point is that perspective is important. But if you're not a person who needs this money for other reasons, daughter's wedding, son's education, blah, 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 within the next 6 to 9 months, right? This is the best time to invest because you want to buy, like they very often say, right? When people ask why, not when people ask why not.
Right.
Sunil Gavaskar said this about his retirement. He got 96 in his final test. People asked him, why are you retiring? You almost got 100 in this test. He said, I want to retire when people ask me why, not when they ask me why not.
Right.
Unfortunately, many other cricketers have not been in that position. People are asking them why not, and only then they left. I will not name them. But why I'm saying this, markets also are similar, that you have to buy when there is fear in the market. And today, fear is at its max, right? You have to buy. And actually, though I said manufacturing plus banking, to me, it really doesn't matter because everything is corrected. Just whatever your portfolio, you've decided before the war that based on my goals, this is the mix: gold, silver, large, mid, small sector. You had arrived at a particular mix for your future, some with a 5-year outlook, some with a 10-year outlook, some with a 15. We would have done that. Just buy the same goddamn thing in small amounts. Because nothing for India, none of this is permanent damage to India. Oil, like I said, oil rises as fast, it falls as fast. All things will come back when the war settles. 6 months after the war has settled, it will be back to the fundamentals of India. And the fundamentals of India are nothing to reiterate again that we have a surplus of young people who need to be given jobs and going through the manufacturing route to supply to the rest of the world is the only way India's future growth story is going to go from its current 6-7% to a 8 to 10 double digit growth. And that's an imperative. It may take longer because we are democracy. It may take, and part of the reason is that our traditional services strength led by IT is going to face some pressure because of AI. Whereas in manufacturing, since we are late starters, right from the beginning, we can blend AI into our manufacturing offering. You don't need to hire 10,000 people, lay off 5,000 people and bring AI. We straight away bring in AI and hire only 5,000 people. So my perspective there is simple. Don't overthink the situation. A correction has happened completely unrelated to our own economic future and everything. Nothing is affected. Oil is a dependency for the Indian economy. It has got hurt by certain forces at play, but those are not permanent forces. When they go away, oil will bounce back. It will go back to normal. There will be a period of adjustment. It's not like aaj kiya to kal ho gaya. Nahin. There will be a period of adjustment, but for a long-term investor, these periods of adjustment when the market is still trying to figure out where to put the money is when you put the money to where 5 years later you believe your value will be delivered. So just stick to that. And I presume that before the war started, you would have put in certain amount of homework, taken advisor's help, and to build a thing for yourself. Nothing has changed fundamentally for India from a medium-term perspective. So stick to that same thought process and allocation, I would say.
No, this is awesome. This is brilliant. So much of wisdom, so much of insights that I got, especially the FIs part that you spoke about, especially the value play now that IT has become. Sunilji, thank you so much. Yes, please go on.
I just want to summarize with one final thing. The 60,000 crores you mentioned of FII sold this month, right? I want to tell people that 60,000 represents 20% of the total volume of FII buying and selling in India.
Right.
So please listen carefully to what I'm saying.
Right.
So if 60,000 is 20%, then the total volume is 3 lakh crores.
Right.
Correct?
Yeah.
Of the 3 lakh crores, how did 60,000 come? Was 1,80,000 crores was sold, 1,20,000 crores was bought.
Right.
Correct?
Correct.
So what I'm trying to say is 1,80,000 crores was sold because of short-term FIIs, short-term investors pulling out money from India, people trying to bet, people trying to make money out of by shorting the market.
Right.
Who is the 1,20,000 who was still buying in this period?
Right.
That is your pension fund, your insurance fund, who is looking at 10 years later in India, saying the same stocks which have already been buying in India are today suddenly available so much cheaper, and he's going on buying. So even through this crisis, there has been in this month 1,20,000 crore worth of FIIs buying Indian stocks. Put yourself in that situation as a long-term investor and follow the same principle that pension fund is following. That's my final bit of advice to people, that FIIs are also buying. They are different from the FIIs were selling. You behave like the FIIs were buying.
No, excellent. This is another important point that you raised, that it's not that all FIs are selling. Yes, of course, at top level, net, they are sellers, but there are still buyers. So no, that really gives us that perspective as well. Sunilji, thank you so much. I know we're going to run out of the time very soon now. So once again, thank you so much for giving me your precious time. Really means a lot. And I'm sure the viewers who are watching this would have got a lot of insights. And above all, I keep telling people and myself that, world is not falling down. It's good time to invest rather than panicking and selling your portfolio. And a lot of people will get out of stock market. They will exit stock market. I can tell you that this has happened every time. But they will come back when the market is, touching all-time high, and they won't be able to get the market, back into their portfolio. So don't do panic selling. Be calm. And if anything, you don't want to do anything, just keep away for 6 months. Come back and see your portfolios. You will thank us for that. With that, Sunilji, thank you so much. And I really appreciate it once again. See you guys we'll bring you Sunilji again at some point in time in future.
Thank you.
Thank you. If you haven't yet subscribed to our channel, humble request that you hit the subscribe button now, because your subscription is our motivation. My team and me gets really motivated once we see your subscription. So please hit the subscribe button now, and I'm going to see you very soon. Until then, keep rocking.